I have clients that would tell me they're in deferment and that it does show up on their credit report and that it is zero.
Okay. For their monthly payment.
Yes, their monthly payment is zero. So they should be fine because they're not in a payment plan or they're deferred.
That may be fine. It depends on what other debt they have on their plate and how much money they're trying to borrow. See, here's the thing. What is often not told to the customer is that you want to give yourself a buffer. You never want to buy at the top of your budget. You want to give yourself enough room so that in case of emergencies or in case you no longer qualify for a deferment or forbearance on your student loans, that you have enough room in your budget to repay the debt that you already have. So it's not wise to go into the home buying process as if you're never going to repay your student loans. Some people, they may
I think that's the mindset too.
Yeah.
It's like, I'm not paying these.
Yes. And you know what? On a personal note, that hurts the person more than anything. You're a homeowner, but you have all this debt and you're not conditioning yourself to repay. You're just conditioning yourself to have bills that you just gotta pay for the rest of your life. And when you think about it, depending on where you're trying to be in the future, your 5-10-year plan, is that the quality of life you want to have? I don't think anyone would just choose that purposefully.
Right.
So I really do encourage people to that do have student loans, look at your personal situation. What do you have going on within the next 5 years, 10 years? You have, let's say if you have teenagers, do you still want to have student loan debt when your children go off to college? So like those are questions that do have to be asked when you're thinking about future and planning, especially if you don't want your children to fall into the same pitfalls that you may have because you didn't know.
Right.
Because trust and believe, our children learn about finances primarily based on what they see their parents do.
That is very true. If someone does have student loans and they're not in a deferment and they just have them, do they need to be in a payment plan prior to buying a home?
It would be helpful. Don't just let it sit, but that's a bill that's your responsibility, so at least, get a repayment plan set, because depending on the type of loan the customer qualifies for, automatically 0.5% up to 1% of their balance is included into their debt to income ratio. For example, a popular loan product is the FHA loan, okay, which gives room for first-time home buyers to put a low down payment. However, if the customer has $100,000 in student loans, 1% of that is $1,000, and that $1,000 is included in their debt to income ratio, which means that their home buying potential will be automatically reduced by $1,000 a month.
That's a whole mortgage.
That is
$150,000 house.
Yeah, basically at this point, it's because interest rates are really good. And $1,000 a month, including estimated taxes and insurance, that's like a $170,000, $180,000 loan. So if you only qualify for an FHA loan, for example, and you have $100,000 in student loans, you're reducing your purchase price by $180,000.
Wow.
And that's a big jump. Okay.
That's a big jump, especially if somebody in their head has already begun looking at homes and they kind of know what Zillow told them that they could afford and not taking into account this debt that's going to be included basically into their DTI.
Yeah.
Their debt to income ratio and determining how much the lender says that you can qualify for a mortgage.
Yeah. And here's another thing that I want to say about that, as far as your debt to income ratio. Even though there's a maximum, as far as like what the lender will allow with your debt to income ratio, even though there's a maximum, depending on your credit history, it doesn't mean that you can automatically go to that maximum. For example, if the maximum debt to income ratio is 45%, but say like if you had a history of late payments, if you have like over 10 credit cards, if your job history has been sketchy, some lenders may say, okay, your debt to income ratio cannot be over 43% or 38% because we want to make sure that you show enough can afford what you're going to buy, not buy at the top of your budget.
Right.
Does that make sense?
It makes sense.
Mm-hmm.
So an IBR, can you tell me what that is?
That's the income-based repayment plan. Then that's popular with student loans. Simply put, that is saying, okay, well, based on my income, I may not be able to afford to pay what you want me to pay. So based on my income, can you give me a little concession or give me a little grace to pay a lower payment rather than what you really want me to pay? For example, if I have $100,000 in student loans and they want me to repay $800 a month, I'm going to say, well, I can't afford to do that because my income is this, this, and this. I have this going on as far as like how many children, my household income. So instead of paying $800, can I pay $300 or can I pay $0? And that is what happens in the income-based repayment plan. Also, what happens is the interest still adds up on your balance. So that means that, say, if you have $100,000 in student loan, and depending on your interest rate, if let's just say $1,500 in interest accrued for that year, it's added onto your balance, and now you will owe an additional $1,500 on your balance.
Wow. So with your IBR, will the lender accept that as my debt?
They will accept that if you qualify for a conventional loan. And typically with conventional loans, you have the option to put, they have low down payment options, 3% down, 5% down, but they also look at your 24-month to 48-month credit history previously to see if you've had late payments. They also look at your credit score. They also look at how much money you're bringing to the table, how much you have in your savings. So you do have to prove that if you're using an IBR on a conventional loan, you also have to prove that you're credit worthy for a particular loan. That it can't look as if you'll be struggling, or if you miss one paycheck, you don't have anything to fall back on. It can't be that tight.
Right. If I'm in an IBR, conventional is the only one, FHA won't use that, or they automatically use that 1%?
FHA automatically uses that 1% per their guidelines. Now, here's the thing. Even if FHA uses 1%, depending on the customer's credit rating, they may be allowed to go up to a 54% debt to income ratio.
Gotcha. So then that means they could qualify for more or have higher debt.
Yes.
And not actually be making a payment.
Yes. So that student loan will be taken into account, but they will allow the debt to income ratio go up to 54%. I've done a loan for a customer who was in that circumstance, had over 120 in student loans, but was on the income-based repayment. And the kicker is she had to pay off her car in order to qualify. So it depends on the circumstances.